On January 3rd, after learning from these developments, the board and other bank regulatory agencies issued another statement advising banks to be focused on a list of several key risks. The list ranges from the risk of fraud and scams of crypto participants to money laundering and terrorist financing to stablecoin run risk. Later in January, the board issued a policy statement making it clear to the banks we supervise that the board would apply the same permissibility standards to activities, including crypto asset-related activities, regardless of a bank's deposit insurance status. The preamble to the statement made clear that we would likely view it as unsafe and unsound for banks to directly own crypto assets on their balance sheet. In addition, we clarified that the banks were supervised seeking to issue stablecoins or dollar tokens would have to show that they have controls in place to do so in a safe and sound manner, and that they would need to obtain a non-objection notice from Federal Reserve supervisors before proceeding. On February 23rd, we provided additional clarity about supervisory expectations through another statement issued jointly with the other bank regulatory agencies. This statement was also informed by recent supervisory experience. The statement highlighted to our supervised institutions that they need to be aware of the liquidity risks associated with certain crypto sector affiliated deposits. We always expect banks to assess and manage the liquidity risks of their funding sources. As the statement makes clear, and has been obvious throughout the last few months, crypto sector depositors may have assets that can be affected by volatility in the sector. This volatility can lead to unpredictable, rapid, and correlated deposit inflows and withdrawals. And thus the liquidity risks of their deposits, of course, require additional attention. These liquidity concerns are particularly acute for banks that have a meaningful portion of their balance sheets funded with such deposits. Again, we took these steps to make clear that we have the same expectations for all the institutions that we supervise and which seek to engage in novel activities. These expectations are not new. We expect supervised entities to ensure that they conduct their activities in a safe and sound manner and in compliance with all relevant laws, including anti-money laundering laws. These public statements are transparent and provide the same information for everyone, including for small banks that may not have large teams of analysts assessing industry developments, large banks with more resources, and of course, the public. We plan to continue to publish guidance of this kind as we continue to examine activity in the sector. In addition to sharing what we learn with the public on an ongoing basis, we're also enhancing our supervision of these activities. We are creating a specialized team of experts that can help us learn from new developments and make sure we're up to date on innovation in the sector.